So let's now go on to our next story, the housing market. So there's going to be big things coming for the housing market. So look at this. Everyone thought that, mortgage rates were making their way down again. Well, we can see here the US 30-year mortgage rate rises to its highest level since mid-November. And I think we're about to start to see those 7% mortgage rates again, everyone. So the contract rate on a 30-year fixed rate mortgage rose 9 basis points to 6.7%, the highest since the week ended November 11th, according to Mortgage Bankers Association. The group index of mortgage applications to buy a home fell for a third week and still the weakest reading since 1995. Now, also here, the Federal Reserve has just put out some comments and some analysis and research, and they say US home prices could plunge 20% as risk of a global housing slide looms, Dallas Fed says. So this is right, everyone. It's not just going to be a US housing market crash. Where I'm in Australia, house prices are crashing much faster than in the US. That's because most people have variable interest rates here. At least they did before the pandemic. Now, a lot of those people that did fix their rate below 2%, that's right, you could get mortgages below 2% here in Australia. They're going to be expiring, about 800,000 of those late this year. And again, in Europe, UK, etc., we're going to see a huge housing market crash. So let's see what they think could trigger this crash here. So US home prices could plunge nearly 20% as erratic market activity and rising interest rates drive a risk of a deep global housing slide, the Federal Reserve own researchers said in a report Tuesday. So that's right, everyone. Erratic market activity. So we saw absolute crazy house price rises during the pandemic. Some areas, doubled or went up 50%. This was just simply unsustainable. And this was driven by a lot of FOMO. A lot of people were buying holiday homes. A lot of people were moving. But we're now going back to more normality. So maybe a lot of people that thought they could afford that holiday home, they're going to be forced to sell that. Maybe people that moved interstate, maybe they don't like the move, maybe they want to move back home. So we're going to see a huge correction in the housing market to get things back to more normal levels. And there's a lot more indicators here to prove that the math right now for the housing market just doesn't make sense. So Dallas Fed economists pointed to signs of trouble in the US and German housing market, and I guess you could pretty much say everywhere else in the world, that pose a vulnerability to the global outlook because of the size of those nations' economies and significant cross-border financial spillovers. The researchers noted exceptional growth in key housing market indicators such as home price to rent ratio and real house prices show signs of affordability crisis. So that's another thing I don't hear many people talking about right now. The rent, the yield you can get on homes right now just don't make sense. They're building a new estate next to where I live. House is around $600,000, but they're only going to rent for about $420 a week. So if we go $420 a week, and if we times that by 52 weeks, so that's $20,000. So you're only getting about a 3% yield there on a $600,000 house. Maybe a bit more than a 3% yield, roughly. Just doing some quick math here. So simply, why would you invest in real estate? And that's gross yield before expenses. When I'll get into a moment, people are piling into bonds right now. You can actually get a 5% risk-free yield unless the US government defaults, or here in Australia, I'm sure a lot of other bank accounts, a lot of banks are offering 4.5% interest on deposits now. So why would you invest in real estate when it's a lot of work? You have to manage the property, manage the tenants, deal with maintenance, when you can just simply put your money in the bank, get 4% interest doing absolutely nothing, or just buy a short-term treasury bond. Price to rent ratio compares home prices to the cost of annualized rent. So US home prices would need a 19.5% correction to bring the US in line with its fundamentals, researchers Lauren Black said in a report. So we go down here. In a recent note to clients, Goldman Sachs projected that home prices will fall 6.1% this year on the national level. So with interest rates rising on the 30-year fixed rate mortgage to 7%, what I think we're going to need is the unemployment rate to tick up to force people to sell. We're going to need inventory to start ticking up, and we'll have to see what happens. But like I said here, it says the prices could fall 20. And I think that's definitely likely. Because, like I said, the rent ratio, investors aren't going to be buying all these hedge funds that were piling into real estate to buy these single family homes. Well, they're just going to go into bonds. And